right. Hello, everyone. Like Amy said, my name is Tanya Rule, and I lead the Affordable Care Act services for Ida Bailey. I sit in our Mankato office, but as you can see on the screen, I am part of our national tax office. So a little bit about me. I live near Mankato. I have 3 kids. And one of my children, my daughter, was in one of her college courses, and the instructor was talking about the Affordable Care Act. And she came home from school that day and she said, Mom, she goes, I knew all of those answers to the Affordable Care Act. He pulled her aside and he said, how do you know all these answers, Alyssa? And she said, well, my mom teaches on the Affordable Care Act, and this is all we talk about at the dinner table. So while I love to talk about the Affordable Care Act, we could actually probably talk about this session for about 4 hours today. We'll try to get through it as much as possible. There's a lot of nuances that we're seeing employers are still kind of making errors on. So we're trying to bring this session starting at the beginning, explaining how the process of the Affordable Care Act, how the exchange and how the forms that the large employers submit to the IRS, how they are supposed to work. As we'll talk about in a little bit, we'll see that the good faith relief effort is gone for 2021. What this means is that the IRS could actually hit you with a penalty if you file an incorrect form. Now, we've been filing these forms since 2015, and the forms that we see come through our office are oftentimes not correct. So one of the services that we offer here at iBailey is to review forms that large employers file and prepare on their own, or that their payroll service prepares for them. We even do it for law firms. And when we get those forms in, only a little over 2% of the forms that we see are filed correct as is. Now, we're not looking at ours. We're simply looking at the forms to see if they're filled out in their entirety and see if there's any code violation errors. So, when we see that not even 97% of those, I should say 97% of those forms are in error, that's a lot of forms to still be in error when this is coming up into 2021. So hopefully if you can, watch this webinar, I think it's going to be recorded. Hopefully the recording works. Look through there. I would encourage everyone to read through the instructions, understand those codes, and if you have questions, please contact us. So before we get started, I'm going to let Sean introduce himself.
Hi everybody, Sean Delury. I'm out of the Minneapolis office. I've been working with the ACA as long as Tanya has, although my kids aren't as old, so we don't talk about as much at the dinner table, but we do talk about healthcare some, and that's fun, maybe when they go to college. So yeah, I've been working on the forum since they started in 2015. We'll talk about a lot of the issues that Tanya laid out, and we'll just kind of keep moving in the interest of time. So
perfect.
Thanks for being here.
Thanks, John. So here's our learning objectives. We'll go through a few of the updates. First we're going to talk about the process, how the ACA is supposed to work. We're going to discuss those notices and some new items that are coming through on the notices. And we'll talk about those furloughed employees, our measurement periods. The measurement periods, the rules haven't changed. However, the rules are complex. So Sean's going to go through the measurement period so we can understand what is the importance of the look back. And if we get it wrong, what does that do to us? We'll talk about we'll go through hopefully some examples at the end of the seminar. If we run out of time and you don't understand why the answers are what they are, please send me an email. Here's some ACA terms. I'm not going to go through them. They're all terms we hopefully should all know, and hopefully we'll see most of them throughout the slides. So Sean, why don't you talk a little bit about the Supreme Court case, please?
Yeah, just briefly, because the question comes up every now and then on the Supreme Court case where it's at. So I just want to have a one slide look at the results of it. So the latest case started with California versus Texas, and you can see the image on the middle of the right side there of the United States. And we had Texas in green, and some of the other states were looking to overturn the ACA, and then some of the orange states were on the other side to keep the ACA. So the whole thing started around that argument there on that second bullet point from the top, that without the penalty, the ACA's minimal essential coverage provision was going to be unconstitutional. So, that's when the Trump tax cuts came into play, and they reduced the individual mandate penalty from a nominal dollar amount, or sometimes not nominal for others, but from a dollar amount to zero. And they thought, well, that's going to make the ACA unconstitutional, because that was a main premise, or one of the stools that held the ACA up. So the district court in Texas agreed with that and sent it up to the Fifth Circuit Court, and they concluded that the individual mandate was unconstitutional. So they agreed, but that the mandate might be severable from the rest of the ACA. So that was a 2-to-1 decision that it was unconstitutional, and they tossed it back to the district court to take a look at the severability clause, meaning did the entire ACA, become unconstitutional or just part of it? So the Supreme Court intercepted it or took it up, and they took a look at the case and they ruled 7-2 on June 17th that the ACA would continue because no one was injured under the current law. The fact that the individual mandate was reduced to 0 meant there wasn't anybody injured. So, it was a 7-2, so pretty, I don't know, obvious is the right word, but a pretty, smooth decision. It wasn't a 5-4 decision. So 7-2 to keep the law. So in the end, through all that, there's no change to the ACA as a result of the Supreme Court case. So I'll toss it back over to you, Tanya.
Perfect. Thank you, Sean. So let's talk a little bit about how the ACA works, so we understand why the 1095s and the need to have the correct 1095s are important. So when an individual goes to the exchange, whether or not they receive a premium tax credit, they get a 1095A. Individual gets a copy of that, and the Internal Revenue Service gets a copy of that. Now, when that person goes to the exchange, if they qualify for a premium tax credit, they're to tell the exchange who their employer is. At that point, in a perfect world, the exchange is supposed to send back to the employer what's called a 1411 certification. Now, we've seen the exchanges be delayed on these mailings. We've also seen the exchanges not sending the 1411 certifications. Just because they don't send the certification, you should know that that's not an excuse to not pay the penalty. I know we've heard that back and forth over the last few years. The IRS will still send you a penalty even if they didn't receive, even if you didn't receive that 1411 certification. So as an employer when the employer gets a 1411 certification, they open it up and they say, hey, the exchange will say, Sally is qualified for premium tax credit. Please let us know if you feel that that could be an error. Now, if Sally's employer offered her insurance, they should respond back and say, we offered her affordable coverage. Here's the documentation. At that point, the panel of judges will look at it and send it back to the exchange saying, hey, listen, Sally shouldn't have received a premium tax credit. Here's the documentation. And then the exchange will go back. And ultimately what you're trying to do is you're trying to get it so you're kind of stopping the buck, so to speak. Because when that 1095A goes to the IRS and it says Sally received a premium tax credit, that is what's going to trigger the employer shared responsibility payment and the notice, the letter 226J from the IRS to the employer. Now, I should say that, interestingly enough, we have seen it where an employer actually has the employee on their insurance plan, and the employee still goes to the exchange and gets a premium tax credit. Why that is because the employer was paying, let's say, 100% of the employee's health insurance. They allowed the spouse and dependents on the plan, but they weren't paying for that coverage. So the family goes to the exchange and receives a premium tax credit, and the employee just piggybacks onto that exchange plan as well. So you want to be cognizant of that. Now actually, if the spouse and dependents are eligible to go on the plan and the plan is affordable to the employee, they cannot receive a premium tax credit. Probably a little bit more detail than we need to go into here today. But then that 1095C, so at the end of the year, the large employers that we'll talk about in a minute, they file a 1095C with the IRS. They also give one to their copy of it to their full-time employees. Now that 1095C, the IRS will marry up that 1095C with that 1095A, and they'll say, listen, Sally didn't receive an affordable offer. Line 16 is telling me that it wasn't affordable. So that 1095A, when she received a premium tax credit, is good, and the employer should pay a shared responsibility payment. And so then they'll kick out a letter 226J to the employer. That's why we want to make sure that if we get the 1411 certification, we respond back to the exchange saying, hey, no, listen, this employee received an affordable offer. We also want to make sure our 1095s are done correct. So when the IRS is looking at that line 16, they know that an affordable offer was made. Now, we'll talk about the notices here now and what's coming up with 2018. So new in 2018, the IRS is looking at those 1095s sees that the employers are filing, and they are looking at the W-2s of the employee and saying, hey, listen, this employee didn't receive an affordable offer. We disagree with how you filed that form. So you may receive a letter 226J with some funny codes on it on the one of the forms that comes inside that notice. It's called a Form 14765. If you receive that and you don't understand why that coding is the way it is, it's because the IRS needs some more information on that affordability. So that is new in 2018. IRS is still looking at 2018. They are not done with 16 and 17 yet. So that you could still see a 16 notice. However, once they're on 18, the likelihood is rare. We have seen it. We'll talk about that in a minute. Once you get those notices, you have 30 days to respond to the notice. Now, oftentimes when we see those letter 226Js coming through, they're coming through because the forms were simply done incorrectly. We do see some of them come through where it was an unaffordable offer and that penalty will stand as is, but a majority, I would say probably about 95% of our notices that we receive from employers are because simply they filled out the forms incorrectly on their end. So the letter 5699, these are still coming out. Actually, I saw one of these come out the other day for 2019, so they're a little bit more current. You still have 30 days to respond. This is simply the IRS saying, hey, we think you're a large employer. Please let us know if you are a large employer and where your forms are. Now, you should note that if you get one of these, you're still required to e-file those forms to the IRS. So submit them electronically if you have more than 250 forms. If you simply paper file those forms, the IRS will send you a penalty as you're required to file those electronically. You have 30 days to respond. You're going to have to probably call the IRS and get an extension on that because it's pretty hard to get those forms done and find a payroll software company that will e-file them within that 30-day window. Don't ignore this form. It's harder to get those extensions if you ignore that initial notice. So this is a little bit old, but I put this in there just so people know that, hey, listen, we're not the only ones saying get those forms reviewed. It's pretty important to have those forms reviewed. Get someone in your office to read through the instructions so there's a second eye on those forms. Send them to your tax accountant. Have someone review them, especially this year coming into 2021. Always better to be proactive than reactive. Part of that good faith effort, if you notice there's an error on the form, you're actually supposed to submit corrected forms to the IRS. When you submit those corrected forms to the IRS, excuse me, I should say, hopefully it's before you get that letter 226J notice, because once you get that, you can't submit a corrected form for that year. If you submit a corrected form to the IRS, I would suggest sending it in some sort of a uh, get a receipt that it was mailed. We've had it before where we help an employer go and correct his forms, and then they get this notice in the mail like a week later. And it was just easier for us to respond back to the IRS saying, "Hey, we already amended these forms. Please look for the corrected forms. Here is actually the receipt showing the date that they were mailed." Now this notice, notice 2020-76, this is the one that I was talking about earlier that gives us kind of that final date. So 2020 were our final forms that were filed that have that good faith effort, meaning if I make an error on the forms for 2021, likely the IRS will penalize us. Simply just like they penalize us if we filed an incorrect W-2. So a couple things to look at if you're filing those forms, make sure your ACA software is set up correct. Make sure that you're filing forms to all the employees who are to get forms. Use the appropriate safe harbors. And we see that a lot of times employers aren't coding every single month for line 14. So even if a safe harbor isn't applicable, you still have to use all 12 months or each individual month for 12 months for line 14. Remember the cents go on line 15. So if the policy is $100, it's going to be $100, 100.00. Here are our current penalties for the forms. So it's up to $280. Remember, there's a form that goes to the IRS and a form that goes to the employee. So I put this in here because I think this is still pertinent. Back in February 2020, we had a chief counsel memorandum came through that said there's no statute of limitations on these forms. And it's simply because by filing the 1095C form, until the IRS sees the 1095A form from the exchange, they don't know if they're going to penalize the employer or not. Remember, I could have a million full-time employees and not offer them insurance. And as long as none of them go to the exchange, nobody would trip the penalty for the employer. So because there's no statute of limitations, you're going to want to make sure that you keep all of your 1094 and 1095C forms, as well as the backup documentation. We have seen it where an employer will get a notice from 2016 and they think their 15 forms are fine. And about a year later, the IRS comes in and they look at the 15 forms. So just because they're looking at your 18 forms now doesn't mean they can't go back. Few and far between times they do, but this just tells us they can go back. I believe the instructions this year are probably going to state the same thing, that you should keep your records for, I believe, 3 years. That's a little bit misleading. Keep them indefinitely. So now we're going to talk about what is a large employer. Well, hopefully everybody knows if we have 50 or more full-time equivalent employees, we are a large employer. What I see companies do is they forget to include all their related entities. So we're looking at that ALE status. Remember, that's always done on prior year hours. So if I'm an ALE for 2021, that means that I had 50 or more full-time equivalent employees back on my 2020 calendar year. It's based off of 120 hours per month. Remember, once I am an ALE, that's when we look at 130 hours per month. Now, your furloughs and your layoffs, they're going to potentially affect that ALE status for 2021. I know last year when the furloughs were taking place, um, we had a lot of employers say, well, now I don't think I'm going to be a large employer. And I said, no, actually, those furloughs in 2020, employees having no hours of service, that's going to affect your ALE calculation for the current that year, which is for your 2021 year. So let's talk a little bit about the pay or play penalties. So we have the 4980HA penalty, and that's the no insurance penalty. And you'll hear me refer to that as the A penalty. And then we have the 4980HB penalty, and that's the penalty that is if you offer unaffordable or inadequate insurance. So let's talk a little bit about how those penalties work. If I'm a large employer and I don't offer insurance, or I offer insurance, but I don't offer insurance to substantially all of my full-time employees, we'll talk about that in a minute. And if one employee goes to the exchange, I'm going to get hit with the A penalty. Remember, with the A penalty, we always get 30 free employees. So if you get one of those notices from the IRS, that letter 226J, you'll see on, I think it's about page 4, you'll have what's called an ESRP summary table, and that will break it down into a monthly penalty. So let's say I have a fiscal year insurance plan, and let's say the month of January I didn't meet that substantially all test. I would get penalized for the number of full-time employees, and they take that off of your 1094, page 2. They take my full-time employees and they times it by the monthly rate of 225, and that would be my penalty for the year, assuming February through December I offered substantially all of my full-time employees health insurance. Large employers that offer insurance to their employees, but it's unaffordable. If one of those employees goes to the exchange, says thanks, but no thanks, declines your coverage, goes to the exchange, and they receive a premium tax credit, that penalty back to the employer will be the $4,060. Now, this penalty, as we know, is always limited to the A penalty. They're not going to penalize you more for trying and failing than for not trying at all. Remember, this penalty is per employee. So if I have 5 employees go to the exchange, I'll pay the $20,000 penalty. The A penalty, I have 1 employee that goes to the exchange, that's going to trigger that penalty to all of my full-time employees minus the 30. So we're up to our first polling question, Amy. I'm going to read that polling question while you answer it. What is the penalty for an employer with 55 full-time equivalent employees who does not offer affordable or adequate insurance to any of their 40 employees, full-time employees, assuming 1 employee receives a premium tax credit from the exchange in 2021?
All right, well, results are coming in just a little bit slow, so that's okay. We're going to leave this open while Tanya continues on. But Tanya, right now we're looking at 36% that went with option number 1.
Okay. All right. It's not option number 1, it's option number 2, 27,000. So I can't move that screen, so I'm going to walk you through why it's 27,000. We had 55 full-time equivalent employees, but we only had 40 full-time employees. So we only are going to pay the penalty on the 40 full-time employees, but remember we get 30 free employees. So we have 10 employees that we're going to pay that $2,700 penalty on. So the answer is 27,000. Okay, so let's talk about the safe harbors. So the safe harbors, we have 3 of them, same 3 that we've had for the past several years, actually since 2015. The rates are just different. So we have the wages, the box 1 wages. Remember that takes into account our pre-tax, any of our pre-tax items. We have the rate of pay. Remember the rate of pay, it's the rate of pay at the beginning of the plan year times 130 hours. Doesn't matter how many hours I work. I've seen it where someone says, well, this employee worked 200 hours. I'm going to use 200 hours. Nope. The rules say you take 130 hours times the rate of pay times the current year percentage, which is that 9.83%. And that's what an employee can't pay more than that amount in order to use that safe harbor. And then we have the federal poverty line safe harbor. We don't have a lot of people using this because that is kind of the best of the best plans, if you will. Here's some prior safe harbors. I like to include this only because if you get one of those letter 226J notices in, it's nice to go back and say, all right, what was that percentage again for that year? So it's kind of a handy thing to keep in your back pocket, if you will. So we talked about that substantially all test, and that's that 95% rule. So if I don't offer at least 95% of my full-time employees the ability to come onto my plan, and we're only talking about the full-time employees here, it's as if we offered insurance to no one. Now we've seen it before where we have employers come in and they think they meet this test and they don't. They're sitting at 94%. So let's just give an example of how that would work. Let's say I have 100 employees and they're all full-time employees, but I only think 94 of them are full-time. They're meeting the threshold of the hours to be classified as full-time. So I offer 94 of these 100 employees health insurance. Now let's just assume I paid 50% of those premiums for 94 of those employees. If one of those employees goes to the exchange, and remember we've seen it before where one of the individuals that already has insurance has gone to the exchange. So really it could be any of those 100 employees go to the exchange. They're going to trip that A penalty for this employer because they didn't meet the 95% test. So now I've paid health insurance for 94 people, plus I'm going to have the larger of the 2 ACA penalties. Now, several years ago, Sean wrote a really good article. It's out on our website. Not sure if that hyperlink works or not. But if you go on our website and look for the article 2 Unlikely Cousins, we haven't updated it for the current penalty amounts. It's really an article meant to give you the background of how that works if you're using the monthly measurement period versus the look back, because you can trip this test pretty easy because with the monthly measurement method, we're just looking at month to month, who's hitting 130 hours. And oftentimes we miss some of those employees and we could trip this 95% rule. So in your spare time, go read that article. Contact Sean or I if you have questions. Now, if we can use either the 5% or the 5 employee rule. So if we've got 55 full-time employees, we can miss 5 of them. I'm going to let you read through this example on your own, only in the interest of time. Here is an example of how that rate of pay works. And we use a 2020 and a 2021 example. Again, I'm going to let you read through this on your own. Remember, you take the rate of pay times 130 times the percentage. So with that, Sean, I'm going to take it over. Amy, if you wouldn't mind giving Sean control, he's going to take it over for the next few slides.
All right, thanks, Tanya. So Tanya laid out that 95% test and how important that is. I did write that article. It's an issue that we were run into quite early with the ACA, and it continues to be something that we run into with a fair amount of organizations. So the key thing is your full-time employee, because that's what the penalty is obviously based on. And some areas that get tripped up is with a new employee. So you need to look at your new employee and decide whether they're full-time or not. And what you look at is you look at the expectation of the job, or what's a reasonable expectation for that employee. So you look at, if it was a replacement, did the prior employee work full-time or not? You may look at similar positions for the employee. Like I work with a lot of healthcare providers, so they have a lot of RNs, nurses, and a lot of those are full-time positions. So if you have another position, it's likely to be full-time. Another thing is look at the job description and see, did it list full-time? Did it look like full-time type of work? So that'll help you in deciphering, because if they're a full-time employee, like the bottom suggests, then you need to offer health insurance by at least the first day of the month after the initial 3 months of 3 full calendar months, and it can't exceed 90 days. That kind of ties 2 ACA rules together. A good rule of thumb that we see clients use is they use 60 days as their waiting period. So if I'm hired, February 15th, then March, the rest of February, March, and April are my waiting period, and then I'm offered, May 1st. Then we're compliant with the 3 full months and the 90 days. So that's what you do with a full-time employee. And there we go. And then if you're unsure about the full-time employee status, if you use what we'll dive into in a couple of slides about the measurement period, you can classify them as variable when they're hired. That's if you're not sure if they're full-time, or if they're kind of have a seasonal nature to them, you're going to hire them for 6 months or less, then you can consider them seasonal, and you can put them in what's called an initial measurement period, which we'll get into. So instead of full-time, if you use that look back measurement period, you can define them as variable and look at their hours over that initial measurement period. So we're going to dive into, as Tanya said at the beginning, the measurement periods. So there's some key terms to think about when you're looking at that. So the first thing is waiting period, like I talked about. That's the period of time between when they were hired and when an employee was ultimately offered insurance, the effective date of that offer. Again, back to my example of a 2/15 hire date, you have a waiting period for the rest of February, March, and April, and then you have an offer May 1st. Then you can get into, if after I'm hired, you get into what method am I using to define an employee as full-time? Am I using the monthly method, where Tanya kind of alluded to, you're looking at hours every month and seeing if you trip the 130, then you're defined as full-time and you need to receive an offer at that point or shortly after. The other method, like I described earlier, is the look back method, where you look at hours of service over a measurement period. If they're variable, like that sub bullet point says, the initial measurement. And otherwise, everybody else will look at what we've come to know as our standard measurement period. Most organizations have used a 12-month measurement because it's easiest to do. Probably 99% of the companies we walk into or see use a 12-month. So that's what our example will illustrate for both the initial and the standard measurement. So because you're using that, then your stability period will likely be 12 months as well. That's the period of time that you're stabilized as full or part-time based on that measurement. And you do that measurement, you can do it over an optional, what's called an administrative period, which can be anywhere from 1 day to 90 days. And you can look at that period of time and go, okay, I'm going to look at hours over this period of time and make offers to those employees that are full-time and not to those employees that are part-time, if that's your policy. So again, full-time employee status is important. That's what the penalties are based on, the 4980H penalties. Again, you can choose which method you use, the monthly method, which maybe seems on the surface is easier to do because you just look at hours every month and you're tracking and looking at their hours on a monthly basis. If you have a lot of flexibility or a lot of variable employees, or you're just a large company, a lot of those types of organizations will use the look back measurement method is what we're finding. So you'll look at employees over the measurement period, and then you'll have that stabilized stability period where you'll classify employees as full or part-time status. Some other finer points down below is for the monthly method, you can't use biweekly payroll. What you do is you split those into weekly payroll periods. And then both of those are based on the actual start and stop date of a payroll period versus sometimes we'll get the check date and it's actually the payroll periods themselves. So a couple of fine points there. So again, as we looking at a measurement period example in a couple slides down, so the standard measurement period applies to your ongoing employees, and those are employees that are employed as of the start of your measurement period. So it includes your employees that you've had that have worked a full standard measurement period, but also your part-time employees or your hired employees that are starting to enter that standard measurement period. So everybody will get measured during that standard measurement period. The other one I described earlier was that initial measurement period again, and that applies to variable hour employees and your seasonals. So that's a nice thing to use again, because if you don't know if they're full-time, you can take that 12-month period and measure their hours and see if they did work over 30 hours a week, and then you'd make an offer after the end of that initial measurement period. So there, and then that last bullet point, they will overlap. So a new employee, a new variable employee will have an initial measurement period, as you'll see in an example in a couple of slides to come. And then they'll have a standard measurement period as well. So there will be 2 measurements that you'll likely have for those new employees. So another point to keep in mind. And then the stability period is that last one. That's the period of time where they are locked in as full or part-time based on the results of that measurement. So they can either be locked in as full-time or locked in as part-time. And then between that measurement and your stability period, you'll have what's called that administrative period, which is optional. Some clients just don't have them, but I highly recommend putting it in place because it gives you that time to look at your hours and decide whether you're going to make an offer and do so timely. So you have 90 days of length to do the admin period. You can be shorter if you want. The only little caveat on the bottom there is with the initial measurement period, you'll want to make sure that you don't exceed 13 months for your measurement period plus your admin period on the initial measurement. So, you can either do 12 plus 1 admin, or you can do an 11 plus 11-month measurement plus a 2-month admin. We've seen it both ways. So here's our example. So we have, of course, a new variable hour employee. Here's Carter, and he is a new employee who started August 1st, 2018 for XYZ company. XYZ chooses a 12-month IMP starting on Carter's hire date, so 8/1 to 7/31/19. That same company also has a standard measurement period, which is 6/1/19 to 5/31/20. The admin periods for the initial measurement and the standard measurement are both a month. So for Carter, his new employee admin period starts in August 2019, and then ongoing is June 2020 then. So let's say we measured his hours over the 12 months, and Carter measured more than 30 hours a week during his initial measurement, so 8/1 to 7/31. So as a result, on that sub bullet point there, Carter would be classified as a full-time employee for the company from 9/1, just after the admin period, to 8/31/20. So again, as I said before, we must also track his hours during the standard measurement period, and if their hours during that are greater than 30, he'd be considered full-time during the admin period following that standard measurement period, or excuse me, that stability period following that standard measurement, which is 7/1/20 to 6/31/21. So it's kind of helpful to chart it out. We often do this when we look at it with clients. So here's kind of it laid out pretty simply, the same situation. So here's Carter's initial measurement period from 8/1/18 to 7/31/19. Then there's an admin period to look at hours and see if he qualifies as full-time, and then you make the offer. So then his initial stability period starts 9/1/19 to 8/31/20. And as our example was, he was full-time at that time, so received an offer 9/1/19. As you can see down below, the company XYZ also has their standard measurement period 6/1/19 to 5/31. So you can see that outlined there where it interlocks with the initial measurement period. Then we have the admin period following for a month, and then finally we have that standard or that stability period starting 7/1/20 to 6/30/21. And just a brief note on that typically we find it often follows the plan year. So you can have that offer ready in hand by 7/1/2020. Let's say that same facts, except Carter, the employee, is hired full-time instead of variable. So hired on month 1, 2-month waiting period in month 2 and 3. And then we just highlight there's no initial measurement period for the employee at that point because they received an offer in month 4, the first of that month. And then there's no initial stability period as well. The employee is continuously hired, falls into the standard measurement starting 6/1 to 5/31/20, becomes full-time based on that admin period, and actually would receive an offer on 7/1/20, which is actually the stability period, 7/1/20 to 6/30/21. So then there's another example looking at whether this employee, let's say, has worked for the company for 5 years, and then during the stability period, the employee has had a drop in hours. So this is different because this is a change in status. And this is one we run into pretty often, so we bring it out. So drop to part-time status during the stability period. So it's a 6/30/20 plan year, drop to part-time during 10/1/19, XYZ dropped health insurance on 10/1/19. This is a pretty common practice that companies run into. So then the question we ask, and the company asks, hopefully ask, is, was COBRA offered following that drop in coverage? So hopefully it is the case. It's often the case. If it's not, then that last bullet point is what takes place. Then there wouldn't be an offer of coverage for those three months, because they would be considered full-time for those 3 full months following the change. So change 10/1. So you count three full months, 10, 11, 12. If COBRA wasn't offered, then there is a no offer for those months, unfortunately. How the measurement, how the look back works is it's kind of sticky for those 3 months. So you got to keep them in that position and they don't change. However, one way around that is, did you offer COBRA? So if you did, then you just have an affordability question instead of a no insurance question. And then lastly, this is another example of an initial measurement, just kind of set up as a calendar year. So 2/1/19 to 1/30/20 for the initial measurement period. And then they were in the admin period there for the month following. So then 3/1/20 to 2/28/21, they were in the initial stability period, and they were full-time during that. Then they fell into the corresponding standard measurement period from 11/1 to 10/31/20, 12 months. Followed by a 1-month admin, and then again the stability period 1/1 to 12/31/21. So just kind of outline how that looks for calendar year planning instead of a fiscal. And with that, we have arrived at our polling question, and I'll turn it over to Tanya and Amy.
Perfect. Thanks, Sean. An employer with only full-time employees should use the look-back measurement period. True or false? So hours of service. So when we're looking at those hours of service for employees, remember it's all hours that the employee is paid or entitled to payment. So we have to include that vacation, that jury duty. That often is a question, hasn't changed from prior years. So some ACA considerations with furloughs. So remember, we have the 4980HA and the B penalty. How they get affected with furloughs is if I have unpaid furloughs and I have an employee that was actually in their stability period, if I use the look back measurement period and they are in the stability period, that offer has to continue to them because they're in their stability period. The furloughs we talked about a little bit earlier, how it could affect your ALE status. While that is true, if they are a full-time employee, you still need to make that offer to them. Now, honestly, if you have the monthly measurement method, if you're using that, that works out well with those furloughed employees because you're only looking at their hours worked per that month. Some safe harbors for the furloughed employees. Remember, you cannot use the rate of pay for salaried employees if they're on furlough. So you should remember that those safe harbors should be used consistently through groups of employees. So you have to group like-kind employees together. You can't just use the rate of pay safe harbor and then for those employees that went on furlough, use a different safe harbor such as the W-2. So Amy, do we have the answers to that polling question yet?
Yes.
Okay,
Here
what
you
did
go.
we come up with? Ooh, we're pretty torn, aren't we? So if we have all full-time employees, there's really no need to use that look back. That look back is really meant for part-time or variable, and I shouldn't even say part-time. It's really meant for those variable or those employees that they're not consistently part-time, they're not consistently full-time. Their hours are varying up and down throughout the months. If I have someone that's working 130 hours every single month, then it might as well just use the monthly measurement method as it's easier. So, I was out in Washington, D.C. one year for a women's leadership program. And actually, there's a breakout session for the Affordable Care Act, which I don't know how I didn't know that, but there was. And there was this attorney there from New York giving a presentation on the ACA. And this is one area where he missed. And I hate to point out that it was missed, but this is a nice little area for some of our employers that have that are using that look back when those employees are locked in their stability period. His simple response to a question was, if someone's in their stability period, are they locked in that for the entire stability period? And his answer was yes. And in fact, there is a spot in the rules that say we can take them out of the stability period, like Sean had alluded to earlier, as long as that employee switches to a part-time position and has 3 full consecutive months of averaging under 30 hours a week. The first day of the 4th month, we can classify them as a part-time employee. So how does that work? Let's just say that I have an employee that was offered unaffordable insurance. If that employee takes a part-time position on April 15th, I would have May, June, July. On August 1st, I can classify them as a part-time employee. Now, hopefully I offered them a COBRA like Sean had discussed, but then I don't have to worry about the affordability any longer on August 1st. I should state that when they're first hired, they do need an offer of coverage that met minimum value after their waiting period. So another rule that is often overlooked are employees that are rehired. So remember, if I rehire an employee within 13 weeks, they come on as they left off. And I have to make them an offer the first of the following month after they are hired. If you're an educational institution, that is a 26-week period, not 13-week period. So here are the due dates. They are also in the instructions. So let's go ahead and look at these 1094 and 1095C forms. So if we look at the 1094 form, here is the areas that I see most often done incorrectly. So line 18 and line 20 should always be the same number of forms, unless you're, let's say you're a large employer and you've got 20,000 employees, and you have different divisions and each division is filing their own set of 1095C forms, then each division would file what's called a non-authoritative 1094C. Then their line 18 wouldn't match the line 20. Non-authoritative forms we see them few and far between. Actually, you don't even fill out the whole form, so you only fill out part of the form. We're not going to go too much into detail on that because if you, unless you have the same EIN and you have different divisions, you wouldn't really need to file a non-authoritative 1094C form. All the other entities out there are going to file a 1094C form for their one form for each of their EINs. So if you have related entities that you're filing the forms for, each related entity with their own EIN is going to file their own set of forms. Line 22, we oftentimes see employers not want to fill out this line. We do have some payroll companies out there that don't address line 22. You should fill it out if it applies to you. That qualifying offer method, that is your 1A offer. That's if you offer the federal poverty line, if you give that offer out, you can check that box, assuming that that offer was at least to one employee for all 12 months of the year. Now, if you offer at least 98% of your full-time employees an affordable offer and you allow the spouse or the dependents, onto that plan, you can check box D. When you check box D, you don't need to fill out column B on page 2. On page 2 here, what we see done incorrectly is either someone fills out all 13 boxes or they miss column A. And column A is what's going to trigger that 4980HA penalty. So if you offered substantially all of your employees insurance, make sure you check box 23A or whichever months it is pertinent to. The 1095C form, on here I put the red box around line 14 because you have to fill out line 14 for every single month. I saw a notice come through not too long ago where they only filled out July through December and left the rest of the month blank because they didn't think it was pertinent to them. Line 14 has to be filled out for all 12 months or use the all 12 months box. Line 16, if it's not affordable, you're not going to have anything there. I know I'm discussing this with an IRS agent who doesn't quite understand the rules. I'm hoping she's maybe logged into this webinar, but line 16, if you don't have an affordable offer, you are going to leave that blank. Line 17 is really meant for those ICRA, those individual coverage health reimbursement accounts or arrangements. If you have one of those, then that's when you would use that line 17. If you don't offer an ICRA, don't fill out line 17. I know we have some companies out there that are having a hard time with their software not putting in that zip code. So let's do polling question number 3. Can an employer drop an employee's coverage during the stability period? please respond to that. And then Amy, I'm going to keep going.
Sounds good.
So Sean, the next few slides are yours. Do you want to talk through them? And then when you're done, we'll come back to the answers of this polling question.
Yeah, sure. Thanks, Tanya. We just want to touch on some ACA software considerations questions, and we also have an ACA software too, so we kind of tie that together. So when you look at ACA software, like Tanya talked about, how they usually work is they take all the ACA rules that we've touched on, and they take your health insurance policies, your plan year, your premium, your waiting period policies. Are you doing the monthly or the look back? And what they're trying to do is they're looking at the employee life cycle on the right there, or their cycle at the work at the organization, and seeing, okay, were they hired? Are they in a waiting period? Are they offered? Did they enroll in coverage? Did they decline? And then obviously with the health insurance policy, there's an affordability calculation. And then did they term or retire? And then, like Tanya talked about with the rehired rules, did they come back? Were they rehired? And then there's a 26-week rule that touches on. And so the ACA model or software should take all that into account. And yeah, we can proceed to the next slide to talk on some. So it takes that into account, and as you can see, there's some advantages of using the model and software versus not. There's just a lot of questions around it, and once you understand how the model and software works, you gain some of these advantages, and you'll identify those issues up front when you can correct or minimize some of those penalties and fines, the 226J or the ALE status, or some of those that come up. You can identify those, in real time through the year by using a model or software. It'll increase probably the timeliness of filing the 94 and 1095C, just because you're doing a lot of the legwork up front throughout the year. At the end of the year, it gets pretty busy, and you have the W-2s and maybe the offering health insurance and your benefits and all that stuff for your plan year. So you have a lot of things going on. So this will kind of help increase, make it easier to do the 1094 and 1095C if you're doing it throughout the year. Obviously, that minimizes time to prepare the forms, ensures that appropriate coding is made at the right time. We'll get a lot of these, and we'll look at it. On the filing side, what we do is we'll get all the information, and we'll look at it, at the end of the year to get the stamp and get it filed and submitted. But a lot of times we'll find, like Tanya said, there's errors of offers. Maybe we didn't offer to 95% for a month, or maybe 6 months. Maybe we didn't, we missed an offer to an employee. Maybe we didn't make sure it was affordable. We thought it was, and it turned out that the plan wasn't affordable. So it ensures that you can make those things throughout the year and reduce penalties and fines. And with the measurement period, Tanya talked about that one with the change from full-time to part-time. There's a few other things, nuances with the measurement period, and you saw all the different periods that I talked about earlier. So what the model or the software should do is help ease that administration of the measurement period, so that you can do it ongoing or be more proactive and see who your initial measurement period employees, your variable employees are, when they become full-time, when offers need to be made then. So it ensures that measurement period process is in place, so you can make sure that you're ACA compliant on the reporting. And then lastly, I just put a couple of screenshots on the next slide. Thanks, Tanya. On how our model looks. This is an export report, and hopefully you have a giant screen to view this, but I'll just walk through a couple of things. So all software should have some sort of dashboard or reporting function that kind of outlines to you the situations and what you need to look at. So what we have there's two overlays here. On the top part of the slide is an employee ID, and then it'll show you whether they were full-time or part-time based on the standard measurement period. It'll give you some hire dates and term dates to see and key in on why they aren't meeting the measurement, or why their codes are different on the right. And you'll have a term date as well over there showing when the employee termed. And then you'll have hours for 3 years, because we need 3 years of data to administer the look back measurement period. So it has monthly hours for 3 years, and then it'll show the codes off to the right, starting maybe the last third where you start seeing blue and green. So you'll see like 12-month coding and monthly coding. And so you'll see those codes coming in as a result of the hours that are held in the model or software, as well as the hire dates and term dates. So you take all that into consideration, and you get the coding. And then down below, I just kind of circled in blue and had an arrow down below to show what, as you can drill down, at least in ours and probably others, you can drill down into a specific employee and see what their situation is if it's not making sense. A lot of this boils down to like the rehired rules. If they came and left again, you can take a look at this and see when their service period was and when their break in service was. So pretty handy. You know, we have a flat fee plus a per employee fee on the filing. This is probably 15% more to give you a sense of how this looks to do a monitoring versus a filing. So with that, I'll turn it back over to Tanya.
Sorry, Sean, I didn't mean to slide that slide. I was just trying to get my mouse up. So let's go through some. First off, Amy, do you have the answers to that last polling question?
Yes, here we go.
Okay, so it is correct. Number 4 is correct. So remember, we can take those individuals out of that stability period if they've worked 3 full consecutive months under the 30 hours. So let's go through some form examples here. I'll try to get done here shortly so we can look and see if there's any questions. So Lisa works part-time for an employer for 10 years. They use the look-back measurement method. On 3/1/2021, she takes a full-time position and is offered coverage on 4/1 of 2021. She waives coverage. What would her form be? Well, since she waives coverage and she's not a full-time employee, right? She takes a full-time position, but she's locked in that stability period. So we can offer her insurance, but we don't need to give out a form. Remember, every form you put out is a potential penalty coming in, and not giving enough forms is also a potential penalty coming back in. So we want to make sure we issue the right number of forms, not too many, and obviously we need to offer or send out enough forms as well. So let's look at example 2. So Jackson was hired part-time on October 2nd. On October 15th of the following year, he accepts a full-time position and takes coverage effective May 1st. So what does his form look like? So he is not locked in a stability period. So remember, if we change statuses during the initial measurement period, we have to be offered coverage. So if I change from a part-time to a full-time position, I need an offer of coverage. I can have my waiting period, and then the first day after that waiting period, I need an offer of coverage. So actually January through April, he would be a 1H2D because he's in his initial measurement period. Then May through December, we would code him as having an offer. We would put the dollar amount in and 2C because he accepted the offer. Now remember, for 2020, he wouldn't get a form because he's in his initial measurement period. And if you look at the form instructions, that's actually part of what's called a limited assessment period. So he does not get a form in 2020. So in example number 3, so Jamie's hired full-time on April 15th, 2021. She accepts coverage beginning June 1st of 2021. My apologies. Apparently Jamie is a man. He unexpectedly terminates on May 28th. What would his form be? So there's no form because he's not outside his waiting period. So if you have someone like Jamie and they work for you, but they never complete that waiting period, you don't give them a form. Now, oftentimes we see employers wanting to give this individual a form and show that he was in his waiting period and he was going to have an offer, but he terminated. Again, too many forms isn't good to send to the IRS. Doug's employer offers coverage to employees who work 20 hours a week or more. The employer does not have a self-funded insurance plan. Why I bring that up is because remember, we have to give, if we're a large employer, we have to give a 1095-C to all of our full-time employees. If we have a self-funded plan, we also need to give that form to anyone who is not full-time, but who takes our coverage. So that's important to note here. Doug works 1440 hours in the year and he enrolls in coverage for the entire year. We would not give Doug a form, even if he accepts coverage, we don't give him a form because remember, we're not self-funded and he is only working 1440, so he's deemed part-time. He's not working that 1560. That 1560 is your full-time employees. So now we have polling question number 4. You have to answer this for CPE. I know you're probably all looking at the time thinking, are we almost done? So who files Form 1094? Who files a which employees, I should say, should we file the 1095-C form for, along with the corresponding 1094-C? So if you want to answer that, while you're answering that, I'm going to tell you what you should have in your files just to prepare in case you get a letter 226J in from the IRS. You're going to want something to document your plan year. What were your premium rates? I would go so far as having that summary of benefits and coverage. Excuse me, it's only usually about 7 or 8 pages. Put that in your file. If you've got a fiscal plan year, you're going to have 2 of those obviously in that file. You want to keep the copy of those signed waivers. Now I know a lot of people use electronic waivers. There's still a way that you can get a report out saying who waived coverage. Keep that in your file. I would also keep a copy of those W-2s if you're using the W-2 safe harbor, or if you're using the rate of the pay safe harbor, keep documentation of what everybody's rate of pay is. It just makes it easier if you're responding to a letter 226J if you have all of that information. So to answer our polling question, Amy, do we have the responses in yet?
Not quite yet. If you haven't answered yet, please go ahead and answer that.
So here's a slide showing you what we can do to help if you need our assistance. And with that, before we look at questions, Amy, is the polling question done now?
Yes.
Okay.
Here we go.
Perfect. So those who answered all of the above are correct. So each one of those employers in that situation would have a filing requirement. So now, Amy, do you, if I pop up this Q&A, or are you going to read me the questions?
We have just a few minutes here. We can do that. So it says, for employees that drop from full-time to part-time, if they waived insurance while they were full-time, do you still need to offer them COBRA?
Okay, do you want me to take this one? So if they waive coverage, it's deemed that they also waived COBRA coverage. So you only have to make that offer once a year. So you can still list that COBRA amount and state that they waived coverage. Likely that COBRA is not affordable, so watch that affordability.
Perfect. All right, here, the next one. How relevant are the measurement periods if you only have full-time and part-time employees and no variable employees?
Perfect, good question. So if you don't have any variable hour employees, all your part-time employees are working 20 hours a week, there's no variation to it, then you can go ahead and use the monthly measurement method. I would suggest using the monthly. It's easier and there's less chance of an error happening.
I just add, just make sure your part-time employees are under 30 hours a week consistently. You just want to make sure that you're not tripping over that. Otherwise, you might find a month where you're over. But yeah, if you have a large difference between full-time and part-time, then that sounds good.
Okay, one more here. Are there any employer filing requirements when they are a union employer? All employees are covered under the union plan, and the union provides Form 1095B.
Yeah, perfect question, because we see this one come in a lot, actually from IRS notices. So your union will file the 1095B forms, but you still have a requirement to file the C form. So just like any employer that has a fully insured plan, that insurance company will file the 1095B forms, just like your union's going to file here. That doesn't get you out of filing the 1095C forms if you're a large employer. So again, if you're a large employer, IRS is probably going to take it from your W-3, see how many W-2 forms you have, and send you out a 5699 notice. We've seen this over and over again because a lot of people that hire union employees feel like they're the union employees and not their employees, which is unfortunately incorrect.